This is the first of 3 videos about the potential purchase of a guest house, and I thought I'd run through the alternatives. So this is an example of someone who came to me who said that they've just met an accountant, and the accountant has advised them to buy a guest house in their limited company. So they ran through the situation, which is as follows. The husband earned about £75,000 and he was retiring, so he'd have no other taxable income. The wife had no taxable income, and they were going to sell their only property, which is their principal private residence, and put the money into buying a guest house. The guest house would cost £1 million, and that would be funded partly by loan and partly by the sale of their principal private residence. They would run the guest house and they would live in the guest house. So they would live in one of the rooms, and there's about 10 rooms that would be rented out. They expected a loss in the first year of trading because they were setting up the business, and they thought that they would be able to claim something called integral features. Now, integral features are the features of a building, such as air conditioning, heating, central heating, lifts, solar panels, things like that, that you can claim capital allowances on. So that means in the capital allowances, you can extend the loss of the business. So when they met this accountant, what he suggested is that their money would be used, say £250,000 from the proceeds of the sale of their house, be put in share capital into a limited company, and then the company would borrow the rest of the money to buy the guest house for £1 million. The guest house would then be run and it would make a loss. So there's a couple of things to note there. One, you can buy share capital in the company of £250,000, but probably a better option would be that you have share capital of say £100 and you lend the balance to the company in the form of a director's loan. And if you did that, it's easy to withdraw the director's loan. It's much harder to withdraw it if it's share capital. The other thing to note is if there's a loss in the business, and this is the first year, you can only carry that loss forwards to offset against future profits. Now, they anticipated being in the guest house for 10 years, and then they'd probably sell it. And for these purposes, let's assume that it's going to be sold for £3 million. So that means the company would make a chargeable gain of £2 million, i.e. sales price £3 million, cost £1 million. So I don't know what the capital gain, what the chargeable gains rate would be in 10 years' time, but I do know that a company pays corporation tax and hence chargeable gains, currently at the highest rate of 25%. So if we assume the same rate, then that means that when the company comes to sell that property, then it will pay corporation tax on that £2 million chargeable gain at 25%, which is £500,000. That leaves £1.5 million, and they've got to get that money out of the company. Now, if you get that money out of the company, you could get it out by salary or dividend, and on those type of numbers, the highest rate of dividend tax is 39.35%, plus the 25% corporation tax you've already paid. Another way would be to liquidate the company, but again, you'd pay personal capital gains tax on the liquidation of that. You could, however, sell the shares in the limited company, and it really depends on whether the purchaser wants to buy your limited company or wants to buy the guest house that is owned by the limited company. And they have 2 drastically different tax scenarios. So you need to ensure that you consider how you exit a structure when you anticipate setting up a structure. So from that point of view, their prospective accountant had advised setting up in a limited company given that scenario. What I'll do in the next video is I'll run through another alternative, which is my suggestion.